Look at this house. It stands as a silent monument to a market that used to be on fire. In 2022, this front yard would have been a battlefield with 20 offers in an hour and desperate buyers waiving inspection rights, just for a chance to move in. Today the sign is fading, the grass is overgrown, and it has been sitting for 64 long days. It just took an $80,000 price cut, and still nobody is biting. While the national headlines keep telling you that home prices are stable, underneath the surface, a massive unlocking is happening. For the first time in modern history, the 6% mortgage holders officially outnumber the 3% pandemic crowd. The legendary rate lock-in is dead. But before you jump into this new reality, you need to see the shrinkflation trap being set by the nation's biggest builders and the one policy change from the White House that could make or break your equity in 2026. We have spent the last 48 hours synthesizing the latest data from the National Association of Realtors, Redfin's most recent mood reports, and the internal corporate filings of the country's largest home builders. What we found isn't a 2008-style collapse, but it is a full-scale regional correction that has already begun to shift the balance of power. You've been told to wait for the crash, but the truth is that the crash is already here for some, while others are still living in a fantasy. To understand where we are going, we have to look at the crossover point. For years, the housing market was frozen because nobody wanted to give up their 3% mortgage. It was a golden handcuff that kept inventory at record lows. But life doesn't stop for interest rates. People get married, they have children, they get divorced, and they pass away. These life events are finally forcing a surrender. In the third quarter of 2025, we crossed a threshold that changed everything. Over 21% of all outstanding mortgages now carry a rate of 6% or higher. The share of people clinging to those sub-3% rates has dropped to 20%. This is the great reset we have been waiting for. The market is slowly regaining its mobility because the financial penalty for moving is finally disappearing. As more people accept that 6% is the new normal, the supply of existing homes is rising, up nearly 9% year over year. But as the supply goes up, the buyers aren't rushing back in with the same intensity we saw during the boom years. The cost to buy a house in America, including taxes and insurance, is now hovering around $2,600 a month. Meanwhile, renting a similar home costs about $700 less. That gap is causing a massive demand shock that is keeping homes on the market for an average of 64 days, the longest stretch we have seen in over 6 years. While individual sellers are still anchored to their peak 2022 prices, the home builders have already moved on. Builders like D.R. Horton are the cold-blooded market makers of this era. They have shareholders to answer to and debt to service, so they cannot afford to let inventory sit. They are slashing prices to what experts call replacement cost, sometimes selling brand new homes for as low as $158 a square foot. But there is a catch you need to be aware of. To keep these homes affordable, builders are turning to a strategy called shrinkflation. They are literally shrinking the American dream by 300 to 500 square feet. They are cutting out formal dining rooms and walk-in closets, trading space for a sticker price that stays under $400,000. These are the homes hitting the market now, and they are often priced lower than the neglected resale houses in the same neighborhood. This is creating a bizarre dynamic where the median price of a resale home is actually more expensive than a newly built one. It has only happened a few times in the last 40 years, and it is a massive red flag for anyone currently trying to sell an older home. If you are a buyer, this is your leverage. We are seeing a new phenomenon called the weaponized inspection. Buyers who realize they might be overextending themselves are using minor, structural notes as legal trapdoors to escape contracts. Cancellation rates have exploded to over 16% of the entire market. People are walking away after the contract is signed because they realize the floor is much more fragile than it looks. But this correction isn't happening everywhere at the same speed. The housing market of 2026 has become a tale of two countries. If you are looking at Texas or Florida, you are seeing a full-scale correction. In places like Dallas and Houston, inventory has hit record highs, up 4 times from the pandemic lows. In some Austin zip codes, values are already down double digits. But if you look toward the Northeast or the Midwest, the story is completely different. In cities like Hartford, Connecticut, and Milwaukee, Wisconsin, the inventory is still critically tight. Demand is so high in these pockets that we are still seeing bidding wars and prices jumping over 10% year over year. This regional divergence is the most important map you need to study. National averages are officially useless. You could be in a crash zone in Austin or a boom town in Hartford, and your strategy for 2026 has to reflect that reality. Then there is the wild card. The White House, on January 20th, an executive order was signed to stop large institutional investors from competing with families for single-family homes. The order creates first-look policies that give individual buyers a 30-day window to bid on foreclosed properties before Wall Street can even touch them. While these investors only own about 3% of the rental market, they are concentrated in specific cities like Atlanta and Charlotte, where they own up to 25% of the inventory. This policy is designed to shield you from being outbid by a corporation with unlimited cash, but it won't necessarily trigger a mass sell-off. What it does do is provide a psychological floor for the market, signaling that the era of Wall Street's unchecked expansion into our neighborhoods is over. So where does that leave you? The great housing reset of 2026 isn't a collapse into nothingness. It is a migration. It is a transfer of wealth as a generation of homeowners finally unlocks their doors and a new generation of buyers, frustrated and tired of waiting, steps through them. Affordability is finally starting to move in the right direction, but not because of a 50% crash. It's happening because wage growth is finally outpacing home price growth for the first time in years. Your income is finally starting to catch up to the market. This is what a small wins year looks like. It is a slow and steady rebalancing that favors the patient and the informed. The secret to winning in this market isn't about timing the absolute bottom. It is about understanding the equity buffer. If you buy today, you have to be prepared for the 10-year rule. Research shows that in this high-rate environment, it could take a decade to break even when you account for the costs of buying versus renting. If you aren't ready to stay for the long haul, renting is still the smarter financial play in most major metros. But if you are ready to settle down, the power has shifted. You have the ability to negotiate, to demand repairs, and to walk away if the deal isn't perfect. The seller's market of the last few years was an anomaly, a fever dream that has finally broken. As we head into the spring selling season, the inventory will continue to rebuild, and the mortgage rates will likely settle into that low 6% range. The fear of missing out is being replaced by a cautious optimism. The housing market is finding its footing, not through a dramatic explosion, but through a gradual normalization. You don't have to rush your decision anymore. You have the time to look at the data, to understand your local zip code, and to find a home that actually fits your life, not just your panic. The reset is here, the lock-in is over, and for the first time in a long time, the door to the American dream is actually standing open. You just have to be smart enough to know when to walk through it.